If you open any beginner's guide to trading, the first chart pattern you will learn is the breakout. It is the most universally recognized setup in the market. When a price approaches a known resistance level, the expectation is that shattering through that ceiling will trigger a massive surge of momentum. But there is a structural flaw in how most people trade this. That exact expectation of a sudden surge is actively weaponized by institutional algorithms to trap retail buyers. This is known as a bull trap. The price temporarily breaches a resistance line, triggering a flood of retail buy orders from traders trying to catch the momentum. Then the institutional sellers step in, fill their massive short orders against that new liquidity, and the price immediately collapses. Look at the shooting star candle at the peak of this trend. It has a tiny green body and a long upper shadow. This wick represents a liquidity sweep. Buyers pushed past the barrier, but sellers instantly overpowered them, rejecting higher prices. Identifying a valid breakout requires a strict sequence of mechanical, structural verifications that go beyond the visual crossing of a line. The difference between gambling on a spike and executing an institutional trade relies entirely on abandoning visual intuition. You have to use a rule-based system to verify the structure. To build that verification system, we have to look closely at the fundamental building block of price action, the candlestick itself. This diagram shows the anatomy of a candlestick. Notice the clear distinction between the thick body, measuring the open to close range, and the thin upper and lower shadows. The body represents permanently committed price data, while wicks map out temporary excursions. This brings us to the first mechanical rule of a verified breakout. Wicks not count as structural breaks. Entering a trade while a candle is actively forming and crossing a line is the primary error that leads retail traders straight into liquidity traps. During that time, the price is just an unconfirmed excursion. You must wait for an absolute, definitive, solid body close across the resistance or support boundary. A body close proves that buyers didn't just test the area, they maintained control all the way to the end of the session. It signals a verified structural shift in control from sellers to buyers on that specific timeframe. Waiting for the candle to close is the foundational mechanical filter required to survive false breakouts. A body close is necessary, but it is not sufficient on its own. Occasionally, a candle will close past a boundary simply because volume is low and there happens to be no resistance, not because there is true institutional conviction. Therefore, the second mechanical rule is verifying that conviction through volume expansion. A valid breakout requires a corresponding volume spike occurring exactly simultaneously with the breakout candle. The volume should be visibly above average. Conversely, if the price breaches a key level but the volume shrinks, the breakout lacks the energy required to sustain itself. We can add an additional layer of confluence by using momentum indicators, like the relative strength index, to measure the underlying energy of the move. If the price breaks out to a new high, but the RSI forms a lower high, you have what is called RSI divergence. That divergence warns of momentum exhaustion and points to a probable trap. While the candlestick body shows what is happening with the price, volume and momentum confirm who is driving it. This separates random retail noise from actual institutional participation. Even with a perfect candlestick and strong volume, a trade can fail if you ignore the broader environment. Market price is inherently fractal. Structural patterns exist inside of larger structural patterns across different timeframes. You might spot a perfectly verified breakout on a 15-minute chart, execute the trade, and watch it collapse instantly. This occurs when your micro timeframe breakout fires directly into a macro timeframe supply zone or a larger downtrend. Your small momentum hits a massive wall of sell orders. To prevent this, identify a macro break of structure on a higher timeframe to establish the dominant trend. This gives us the third mechanical rule. You can only accept lower timeframe breakouts that align mathematically with the dominant macro directional bias. This requires strict discipline. You must ignore clean-looking, tempting setups on the micro timeframe if they are counter to the larger trend. Context dictates probability. Aligning micro execution with macro structure is the only reliable way to ensure you are not stepping in front of a freight train of institutional momentum. Once all previous structural verifications are met, we move to the final phase, executing the trade. Buying the initial breakout extension is mathematically disadvantageous. It forces you to place a wide stop loss to account for market volatility, which ruins your risk-to-reward ratio. The institutional execution standard solves this by waiting for the pullback phase, also known as the retest. In a retest, the price breaks the horizontal barrier and then drops back down to touch the top of that exact same line. This confirms that old resistance has structurally flipped into new support. You do not enter blindly on the touch. You wait for a definitive reversal candlestick pattern, like a hammer, to form at this newly established support level. The final entry mechanic is triggered only when the first subsequent candle makes a new high above your pullback candle. This allows you to place a tight, defined stop loss immediately below the wick. Trading the retest transforms a high-risk, emotional chase into a calculated execution, keeping your downside mathematically protected. We now have a complete verification sequence that must be cleared before a single dollar of capital is risked. The system relies on 4 essential notes: macro bias, body close, volume confirmation, and the retest trigger. Enforcing this rigorous filter will drastically reduce the sheer frequency of your trade opportunities. This systematic removal of noise and liquidity traps ensures that every remaining trade is backed by hard structural evidence. Institutional execution demands a high probability environment where the chance of a reversal is mathematically minimized. Wait for the close, wait for the retest.